Let's get right to the floor show. Joining me now, BlackRock Chief Investment and Portfolio Strategist America's Gargi Chaudhuri. Gargi, where do we begin? Person like you wake up in the morning during this period of time where we have so much upheaval, and what do you look at first?
Well, I wake up in the morning, I have my coffee, I don't look at the markets immediately, but when I do, absolutely, especially these days, what is crude prices doing? What are Brent prices doing? How are equity markets? How did they respond overnight? The international markets, and obviously that's going to have a huge impact on US markets, and ultimately, what are bond yields doing? Because that's obviously been a huge driver.
And bond yields have been rising on the perception and the belief that if oil is up, gasoline is up, which it is.
It is.
Heating oil is spiking. Diesel fuel. Just yesterday, we showed the average price per gallon of diesel at $5 plus. In some states, it's $6, $7. It's costing truckers more than $1,000 to fill up the tank. It's just nuts. That will translate, if things continue like this, to higher inflation, and therefore no chance of a rate cut anymore this year?
Yeah, so I think that's where some of the opportunities are actually beginning to arise, especially in bond markets. So I will say that, we have a Fed who's in a slightly difficult position. Obviously, on one hand, you have headline inflation led by oil prices, but also, to your point, food prices. It's not just about oil, it's about food as well, given fertilizer costs going up, as well as diesel prices, obviously the transportation costs for food going up. And on one hand, you have that headline inflation expected to move higher. But on the other hand, this is a dual mandate central bank. So even before this, you had the labor market that was showing significant signs of just moderation slowing down. So we don't think that it's likely for the Fed to actually raise rates this year. That's obviously what the market is pricing in right now. It's different in the other single mandate central banks, but the Fed, more likely than not, will not be able to hike, and that creates an opportunity in the front end of fixed income markets.
So you're going against the market belief that there will be a rate hike. We were stunned because we started to look just about October. The Fed rate hike odds for the October meeting yesterday were 20.6. That was yesterday for October. December was 18. Today, it's up to 45 for October and 44 odds of a rate hike for December. So this is a contrarian play. If you are right, do you tell your investors, don't stay in cash? You've got to start picking up some opportunities when they come, and they don't come that often.
Absolutely. So we think don't stay in cash. Certainly use this environment of yields that have backed up pretty significantly to earn some income in your portfolio. Do that in the very front end of the curve. That's really attractive, especially given that we don't believe that the Fed is going to be in a position to hike rates. So what should you do? Really think about that sort of 1 to 3, maybe 5-year part of the curve. We're telling investors to go out to active tickers like BINC, BINC, BlackRock Income,
right,
or SHY, which is an index ticker that gets you that 1 to 3-year part of the Treasury curve. Really great opportunities here to earn some income in your portfolio while yields are moving up, but we don't think they stay there.
So if we were to look at the top holdings for those special income producing stocks, even if the stocks are going down, the yields are certainly attractive. You talk about some of the top names that are in those funds, and what kind of yields are we looking at?
Yeah, so if you look at BINC, which was the fixed income ETF that I talked about, you can really build in that multi-sector income generating portfolio, earning about, give or take, 6%, a little bit more, a little bit less, depending on the day and what yields have done. But the ability to do that, importantly, without taking too much interest rate sensitivity. So really the part of the yield curve that's really had us all scared, and you were talking about mortgage rates earlier, moving up so significantly because of the 10-year, you're not getting that duration. You're not getting that interest rate sensitivity. So earn that 6%, do it in a multi-sector way without taking duration risk. We think that matters. And then when it comes to the equity market, I think this is a time we're telling investors, get closer to home. That might mean U.S. markets, but
really
also
quick,
closer to benchmark.
I hope our viewers have noticed we have switched out our lower third bug to the NASDAQ, which is now down 483 points. Actually, Mike Thompson is looking at it as down 536. I don't know which is correct. Maybe we can just figure that out. But it's 484. Okay, it's 484. So tech. Do you like anything in tech?
Yeah, so one of the things that we have talked about previously in this show with you is structurally, we still believe AI is going to be an opportunity for investors. More specifically, looking at the hardware, the more defensive parts of tech, we think within AI are going to be really important. So focus on power, focus on compute, focus on memory and hardware. That's where we think the opportunities are. And frankly, that is where the earnings growth are as well. Despite some of the price action today, we are still seeing earnings growth come across all sectors of the S&P, but certainly in technology.
Well, again, we've got the NASDAQ in correction right now, and with about 46 minutes left to trade, we'll see if it closes in correction. And of course, that would be a 10% hit since October 29th, back at its most recent high. Gargi, thank you.